Hi, this is Lee Thurburn again, and I want to show you today how to use the analysis tool, the spreadsheet, in an actual case study of analyzing a property that is available for sale. Now, in this particular case, we're looking at a property in Fort Worth on Monticello Drive, 404, and you can see that on the right side of the screen. And this is the MLS listing with the essential data. Now, what I've done on the left side of the screen is I'm showing the spreadsheet dashboard and the rows below it. I can only get in this particular screen share up to year number 4, but you're going to see how I fill in the information and actually complete the property analysis. Now, what I've done on the spreadsheet is a couple of additional things since the last video. The fields that you see, like this one right here, down payment, that are in red, are fields that are automatically calculated by the spreadsheet. So you do not actually plug data into these fields. The fields that are in green are fields where the information is you're going to insert the information from the data that you have available, like on an MLS listing or whatever research that you have done. Now, as I scroll down, you'll see that all of the fields in the spreadsheet are blanked out, or not blanked out, it's not the right word, but they're basically empty because there's no data to be put into these fields yet. So what I'm going to do is I'm going to copy information or move information from the MLS listing into the spreadsheet, and then we're gonna go ahead and go through the analysis process. Now, first, I want to do this. I want to actually show you pictures of the property so that now, obviously, before you do make an investment, you're going to go out and walk the property, do a detailed investigation. You'll have somebody take a look at the property condition, an expert if you're not one. But all we can do in this particular case is take a look at the pictures. Now, there's 39 pictures. I'm only going to run through a few of them, but I want you to see the quality of the property. So this is an external view. This is actually 2 buildings, 5 units. They're sold on 2 different lots, but they're sold as one property. So here's an external view. Here's a different angle of the external view. Very beautiful property in a nice part of Fort Worth. And here are some interior shots. And as you can see, of course, the furniture makes it look really beautiful. But you look at the building itself, it's a very nice building. It's got great fit and finish for the property. So I'm just kind of scrolling through a few of the shots, different rooms, bedroom, and so forth. Exterior deck, there's a couple of different decks. Bathroom, master bedroom, ensuite, looks like a library, study, office sort of room. So these are different suites or different units within the complex of 5 properties. And so I'm just kind of flicking through. So you can see this is a very nice property. Now we're going to presume that let me bring that back. I just actually recovered. I had closed the window, so I had to go back and log back into the MLS. But so here we are. We took a look at the pictures of the property, and now what we're going to do is we're going to go ahead and begin to put information in. So the property has a list price of $884,000. So $884,000, and when I insert that, that'll actually calculate a couple of things. Now let's just presume that we're going to put an additional, because this property doesn't look like it needs a whole lot of upgrades or anything like that. So let's just put an additional $100,000 in additional capital so that we have some working capital for this. Now, our baseline growth rate that we're going to presume is the case is going to be 1.05. So we're going to presume that all expenses and revenues go up by 5% per month. The property, or per year, The property has 5 units, so we'll put in 5. And what we're going to do is we're going to have to look and see what the average revenue per unit is. So currently, the property has a gross income of $48,728. So what I'm doing is I'm looking at this right here. But I'm looking now in greater detail at where that number comes from. So you'll see down in this section here that there are 5 units, 2 that are 1 bedrooms at 606 square feet, $750 a month in rent. So what we're going to do is we're going to add up the lease amounts. And so getting my calculator going offshore here, so $1,500 plus $1,300 plus $1,800 equals $4,600 a month times 12 equals $55,200. Now they're saying the gross income is $48,728. I cannot explain what that difference is because the quick calculation for the revenue from 5 units shows to be 55,000. So there's a unit that has no income. It's the largest square footage, 2,000 square foot, and I'm going to plug in an additional monthly revenue of $2,200 as a reasonable. That unit's obviously not leased. It could be that the current owner lives in that unit. We don't know the answer to that at this point in time. So I'm going to plug in an additional $2,200 a month. So what we're going to do now is we're going to come back up with the following: $1,500 for the two 1-bedroom units, plus $1,300 plus $1,800 plus $2,200. That's $6,800 a month times 12 equals $81,600 a year. So what we're going to do is we're going to divide that by 5 and then by 12. Divide by 12. So we're dividing the total annual rents for all 5 units by 5 units and by 12, and that comes out to $1,360 per month. So we're going to plug in $1,360, and now you see the $81,600 in revenue. Okay, so the next thing that we want to do is now I put in a vacancy rate of 5% as kind of a default. That's a reasonable vacancy rate. Property taxes, over here we see property taxes of $14,762, so $14,762. Insurance, here we have an insurance amount of $2,368, so $2,368. And management fees. There are no management fees that we know of. This is a property that is probably managed by an on-site owner, but we're just going to leave management fees at 0, presuming that you're going to own the property and manage it yourself. And so that gives us a net operating income at time of purchase of $60,390. Now, because we have all of these numbers, we get a cap rate multiplier of 14.6. And you look over here at the gross income multiplier, that's your cap rate multiplier, 18.14. We have a better cap rate multiplier because we're presuming income on the unleased unit. Okay, so now we don't actually know. I'm going to go ahead and scroll over just a little bit. We don't actually have any repair and maintenance or utilities numbers. If all of the units are leased, the utilities will be paid by the tenant, so we're going to put in a 0 for that. We're going to presume that the leasing and advertising is going to basically be the sign in the yard and maybe a little bit of money spent. So let's put $2,000 a year. Contractors, we don't have any specific contractors. We're going to put in 0. We don't have any payroll burden that we have to carry. We don't have any administrative burden. Well, let's put in $5,000 for miscellaneous expenses, and let's put in repairs and maintenance of $5,000 for the year. So we have other expenses of $12,000. This number rolls up into this number, and now our net operating income looks to be $48,000, and 14.64 is still our cap rate multiplier. Okay, so now let's come down and look at the detail of what we have in. So I'm going to go ahead and close this so that we can see the rest of the spreadsheet. Now, the owner in there, let me go ahead and open that back up for just a second. The owner, the current owner, basically says the following: the only vacant main house can be only the vacant long-term tenants and lease amounts do not reflect the current market rates. So they have long-term tenants that have the benefit of market rates that are lower than currently in the market. And it says that the upstairs are currently on a month-to-month basis, and the downstairs doesn't come up for relet until February of 2023. So with that information in mind, let's come over to our revenue growth rate. Well, our revenue growth rate is factored in at 5% per year. But let's do this. Let's say that in the first year we own it, we're actually able to raise the rents by 10%, and likely we'll be able to get a 10% the second year, and then for conservative sake, we're going to go 5% out there for. So it'll grow annually at a 5% rate. Therefore, now this property is in great shape, so we're not going to be able to add any particular added value rental increase. So we're just going to conservatively go with the growth rate that you see here. And we factored in vacancy rates and everything else. So our annual income is now shown as to grow out to year 8 to 125,700. Now, we're going to leave our tax growth rate at 5% per year. We're going to leave our insurance growth rate at 5% per year. There's no management. There's repairs and maintenance. We're going to put that in at 5% per year. And we're going to put leasing and advertising in, growing at 5% per year. This is a simple analysis. And then miscellaneous other costs at 5% per year. Okay, so our net operating income grows at the following rate. And so the current year, if the property was fully rented, that would be $48,000. And then, so we're looking at 55 and so on. So now what we need to do next is we come down, we want to look at our net operating income multiple. Now, actually it should be this. So I'm going to adjust my formulas just a little bit so that they math on out. Now, what we're analyzing here, we have to go get some data from some other sources because we don't have a mortgage interest rate. Let's go ahead and put in a mortgage interest rate of 5%. So it'll be 0.05. Okay, so what we're doing is looking at the mortgage on an annual basis times 12. So basically 0.05 times 12 is 0.6%. So what we're trying to do on this section here, basically this area here, is we're trying to calculate our mortgage debt service. Okay, so now we need to know, mortgage principal and interest. That's not our interest rate, that's our principal and interest amount. Okay, so here's what we've got. We've got 884,000, 25% down, 221,000. So what I'm going to do is I'm going to go to Google. I'm going to look for mortgage calculator with amortization. Mortgage calculator with amortization. Okay, so now what I want to do is go find amortization schedule calculator bank rate. Let's see if this will do it. So we're going to do a loan amount. Okay, so 884,000 minus 221 is 663,000. So 663,000. 30 years, 5.27 interest rate, and our monthly payment is going to be $3,669 per month. So our mortgage principal and interest is $3,669 per month. Now, that's $44,000 a year. So our net cash flow is going to be the following. $55,000 minus our mortgage service is going to be our net cash flow. This line right here is our cumulative net cash flow. So what we want to do is we want to track our total return on investment. We have to look at the cash flow from the property. And you're going to see the property is going to cash flow almost $11,000 the first year, then 18, then 21, then 24, and so forth. So our cumulative cash flow over the time is the almost 11,000 plus 18 is 29, is 50, so it grows. Now, what we do is we look at our cash flow return on investment. And so what we're doing is we're dividing our cash flow of 10,998, and we're dividing it by B61. Come down here, B61. What is B61? It's our total investment. Our total investment is the 221,000 plus the $100,000 of additional capital that we put up. So our total investment gives us a 3% return the first year, then 9%, then 16%, and 23%. Now, actually, that's our cumulative. It gives 3.4% the first year, 5.6% the second year, 6.6, 7.6, 8.7, 9.8, 11%, and then a little over 12% in year number 8 if we own the property that long. Okay, so now our cumulative return on investment just from cash flow accumulates to 3, then 9, 16, 23, 32, out if we own the property 6 years, 65%. So this is a very strong positive cash flow property. Okay, so now the next thing that we want to do is we want to determine, I'm going to go ahead and get rid of the decimals. So I'm going to come back up here to home, and I'm going to put in commas and then get rid of the decimals. So what we're doing now is we're going to calculate the purchase price in the future based upon the income multiplier, okay, the cap rate multiplier. So what we're doing is we're taking our net operating income. So if you look at the formula, it's D43 times D45. Okay, so D43, if we click here, D43 is our net income multiplier. So you see it's 8.27. That's this number right here that my cursor is hovering over. And we're multiplying it times our net income, our net operating income. And so we calculated the net operating income on the first year at 55,000. So 55,000 times 18.27 gives us a property value of $1,005,000. That's compared to our original $884,000. But what we want to do is we want to calculate this return at the time of sale on our total investment. So first we're calculating our expected sale price. So 1 million, 1.1 million, 1.2 million, 1.2.5, 1.3, and so on. So by the time we get out to year number 5, we have an expected sale price of $1,500,000. Now, quite honestly, in today's market in North Texas, I think that's extremely conservative. But that's what the projections are telling us. So now we want to, and this is the point in time that we have to go in and actually calculate some information. All right, so what I've done while I was gone is I got a mortgage calculator. I'll show you the calculator that I used. So I used a calculator, basically calculator.net. I put in our loan amount, our loan term, our interest rate, and then it gives us either a monthly or an annual amortization. I chose the annual. I looked at the ending balance. Here it is, $653. We started with a loan amount of $663, so we went down about $10,500. And so here's $662,242 the first month. Our original amount was $663. We're down to $653. So we went down actually by $9,500. So I'm going to adjust this to $9,500. We're going to make this $10,000 because it goes down by about $500 each. 10.5 and then 11. Oops. And then I'm going to make this 11,700, 12,500, 13,250, and then I'll make this go down about 14,000. And that's approximately what our loan pay down is each year. So our cumulative equity is the 9,500 from year one plus the 10 is 19,500. Now, I want to calculate our total return on equity. So what I need to do is I need to add a combination of the increase in the property value year over year plus the cash flow minus the original investment. So that's what we've got here on this line, total equity appreciation. So we have the, basically if I put my cursor here, you'll be able to see. So I'm adding the principal reduction plus the original, plus the estimated sell price minus the original investment. And so that gives us a total equity at the end of year number one of $351,000. Now we started out with an investment of $321,000. So what I do is I divide that number by the original investment, and that gives us an estimated return of 10%, which is a combination of equity appreciation plus cash flow over the first year. That number then grows to 1.53, 1.74, 1.96. Year number 5, it grows to 2.19. So up here in our dashboard, I grab that 2.19, and then by the time we get out to year number 8, 2.95. What this means is that this property, without any significant upgrades, because it's already a beautiful property, with only the additional leasing up of the currently vacant unit, can provide in a 5-year time frame essentially $2.19 back for every dollar that you put in. Over the course of 8 years, if you held it that long before you sold it, it would provide you back $2.95 for every dollar that you put in. So you get a better than doubling in growth plus another 50% if you hold it for 8 years. So you basically in 5 years you double your money, a little better than double your money, and in 8 years you get about 3 times your money back. That's a great return on investment. It's a beautiful property and a great part of Fort Worth. This is how you use the analysis tool to be able to project for yourself what the return on investment on a property that you're considering would be. I hope that helps. If you have questions, please post them in the comments. Please be sure and subscribe to the channel and like and ring the bell and do all those things. I'd appreciate it very much. And again, if you have questions, post them. I'll be glad to answer them. Thank you very much.